Stock to flow. If you have been in crypto for more than one cycle, you've heard this name. It's probably the most famous Bitcoin model ever made, and also one of the most controversial one. Today I want to show you what this model is, why the original version is broken, and what I do to fix it. The idea behind stock to flow is simple. The more scarce something is, the more valuable it is. Gold is valuable because there is not much of it. Silver is less valuable because there is more. Bitcoin gets more scarce every 4 years. That's called the halving. Every halving, the amount of new Bitcoin being mined gets cut in half. A stock to flow measures the scarcity. Stock means how much Bitcoin exists right now. Flow means how much new Bitcoin is being created each year. You divide it one by the other. High number means very scarce. After the halving, the stock to flow ratio doubles, and in the original model, when stock to flow doubles, the price is supposed to go up by a lot. In 2018, an analyst called Plan B published this model. It went viral, and honestly for a while it worked. The price followed the model pretty closely, but then something happened. The model predicted Bitcoin would reach the $1 million by the end 2025. It didn't, not even close. And the reason is simple. The original model assumes that each halving has the same impact of price forever, that Bitcoin will keep doubling and doubling and doubling without limit. That's not realistic. Markets don't work that way. After a while, Bitcoin is already very scarce, and make it slightly more scarce doesn't move the price as much as it did in 2012. There is also a math problem. Statisticians call it spurious regression. Basically, the original model found a correlation that looks strong but breaks down over time. I wrote about this in detail on TradingView if you want the full breakdown. So I built a modified version. I added what's called a damping term to the formula. The idea is this: each halving adds scarcity, yes, but each halving adds less impact than the one before. The first halving moved Bitcoin from basically zero to real money, the second halving moved it from hundreds to thousand, the third from thousand to ten of thousand. The fourth still up, but not the same multiplier. The model accounts for this. As stock-to-flow gets higher, the price prediction grows, but slower. It has a ceiling built in. It doesn't predict $1 million. That's what you see here. The green line is my damped stock-to-flow model. And the orange line is this a real Bitcoin price. Look at what happened around each cycle top. The orange price line shoots above the green model line. Then it comes back down. This happens in 2013, 2017, 2021. Every time Bitcoin went far above the model, a correction followed. Every time it dropped back to below the model, it was close to the bottom. This is the price stock to flow ratio in the top right corner. Right now it says 1.36. That means Bitcoin is slightly about 36% above the model fair value estimate. Is 1.36 high? Not really. As in 2021, this number was much higher. At the 2020 bottom, Bitcoin was trading below the model around 0.8 or lower. So right now the model says Bitcoin is slightly above fair value. Not cheap, but for sure it's not in bubble. I want to be honest about what this model can and can't do. It's good for one thing, telling you if Bitcoin is very cheap or very expensive related to its scarcity. When the price to stock to flow ratio is below 1, Bitcoin is trading below what the scarcity model predicts. That's historically a good time to accumulate. It's not good for short-term price target. It can't tell you where Bitcoin go next month or next quarter. Anyone who uses this model to say Bitcoin will hit X by December is misusing it. The original Plan B model made that mistake. It gave very specific price targets, and when they didn't hit, people lost trust in the whole concept. My damped version is more conservative. It says, here is a rough long-term fair value based on scarcity. Use it as one data point, not a trading signal or something like that. So where does this leave us today? The damped model puts Bitcoin scarcity based fair value around 57k right now. Current price is about 78k, that's 1.36 above the model. Historical ratio between 1 and 2, the normal bull market territory. Below 1 is deep value, above 3 is where tops tend to form. 1.36 where is the normal range. Not screaming buy, not screaming sell, the model is neutral. Forget the exact number for a second, look at the overall shape. Bitcoin has been trending up along this model for over 12 years. Yes, it overshoots, yes, it crashes below, but the long-term direction matches the scarcity model pretty well. That's the real takeaway. Scarcity alone doesn't determine price, but it's a real factor. And when you combine the stock to flow signal with other indicators, like MRE, Newpol, or the risk bank, you get a much clearer picture. That's exactly what we do in the Fields Analytic platform. Stock to flow is one of the 50 plus indicators. No single model runs the show. If you want to check the current stock to flow reading and compare it with the other cycle indicators, the link in the description. The platform also has a field score, which combines 8 indicators into one number. Right now it is in the buy zone. Subscribe if you want to the weekly update. Every week I go through what the data says, no hype, no price prediction, just the indicators. See you in the next one.